Hey everybody, welcome to another episode of the Business Barbershop Podcast. I am Chris.
I'm Keen.
And today, apparently, we're going to talk about taxes. Before we get to that, though, a reminder, if you like what you're hearing and you think somebody else might want to hear it too, then go share it with somebody. All right? That's all we got. That's our only ask. Okay. Keen, taxes.
Yeah.
What's up? What are we going to talk about?
Yeah, let's talk a high level. I want to talk.
Before we get to this.
Yes.
Although I am an attorney, I'm not your attorney. I'm also not your tax professional. Keen is also not your tax professional. So we're going to talk about taxes. What we're talking about is not advice. So do not go out and act on this advice without talking to your tax professional first. Okay, disclaimer over.
I appreciate that. Saving my ass. So high level. I think the first problem when it comes to, let's say, first business owners in general, but also just in general of like the moments where we start to talk about tax is the perception of why we're doing it. Most people feel like it's an annoyance. Oh, I got to deal with taxes. Oh, taxes are a pain in my ass. Oh, whatever, right? Mm-hmm. And I'll admit, like, I very often take that kind of an attitude on my initial reaction to it. But on a high level, I think it's important we try to adopt a philosophy that when you do it right, changes your perspective to it. And that high level is this. There's only 3 ways to make more money as a business owner. 1, do more sales, like just sheer transactions. So whatever business you're doing, services provided, goods being offered, multiply that, build infrastructure to scale it, and just do more.
Okay.
The second way is do bigger deals. So if your margins are the same and you can sell and do higher transaction amounts, right? If you're selling cars, higher price point vehicles, if the margin is the same, you make more money. So then your amount of effort of creating a sale through either services or goods could be the same, but a little effort towards being a higher price point means overall your dollar amount succeed. The third one falls in the category of taxes, which is margin. If you think about business on a margin basis, you can try to, if it's a cost of goods business, find a way to make your cost of goods lower, find ways to have more efficient operating costs, right? And we tend to think of taxes as like this fourth kind of subcategory, but really it is part of the third category. It's a margin basis.
Right.
If you think about if you do your taxes correctly, nothing else changes except for you keep more money. It's different in that it's happening in the form of like tax savings and strategy than it is like, oh, I found someone, like if you run a restaurant, for instance, a restaurant owner would be excited if they found a new supplier of eggs that was 20% cheaper than where they've been buying it. But yet they'll bitch about these tax strategies that might save them 20% of another cost that might net them the same or even more because it's their perception of it.
Yeah.
Right. But at the end of the day, it's a little upfront effort to try to have higher margins of the money that goes in your pocket. The difference is, of course, is that the normal business margin is normally going to make your tax bill higher, right? Normally, if you find lower operating costs, lower cost of goods, lower staff costs, if you did like, let's say you did like overseas assistant helps or virtual assistants or whatever versus like people in person, other ways to improve your margins, normally those things would actually increase your tax liability because you're making more money.
Right.
But at the end of the day, they're still trying to create the same net result, which is more money in your pocket. And so if you put it in the same category as margin, then you should be excited about it. Like a restaurant owner should be excited about finding eggs for 20% cheaper. They should be excited if they could do the same effort, make the same money, and keep more of it. So I wanted to start with that. Like let's formulate this high level of let's be excited about making more with less effort.
Yes, I would agree.
Yeah. So with that in mind, I thought we could talk about this in a couple of different stages.
Okay.
Let's first talk about low level. This might not even be for normal business owners, but this is actually what spurred the idea in my head to have this conversation. I was having a very long conversation, probably to the point where maybe it was like some liability. I got to go back to that and give some disclaimers now that you gave me that one earlier.
Uh-huh.
But even if you're not a business owner, the process of making more money and having higher value assets should it forces taxes to be on your forefront. And I was talking to a client of mine who bought her first house. And I was telling her, I said, hey, Did you buy an expensive, like she was basically saying like, okay, what can I refinance? This house is so freaking expensive. I can't wait for rates to drop. I'm like, yeah, but as long as rates are higher, like, don't forget that you should be getting some tax savings. And it just kind of went dark. And I'm like, so did you keep your receipts? Did you make any charitable donations? Like, oh, it never saves me money. I'm head of the household and I got kids. I'm like, no, you're missing the point. Like the head of the household thing is relevant. The kids isn't, right? Mm-hmm. There's an income exemption and a credit for having child dependents. That's not the same as itemized versus standard deduction.
Yep.
Right? So when does a person first have to worry about itemized deductions? It happens when you actually have the IRS gives you this list of things that if you pay, you can use them to reduce your taxable income. And it's either you add up all those deductions and they exceed what they're going to give you anyways.
Correct.
Or you take the big lump sum that they're going to give you if you didn't have those expenses or if they just weren't high enough. And so for most people, that moment happens when they buy a house. The reason why it's off people's radars is because between 2020 and 2022, the average interest rate was about 3.5%, with times it going into the twos, right? And so if you bought a house as like a married couple for, let's say, with the average price of a home in America is around like $500,000. Let's just say you financed 90% of it and you have a loan between the high threes to mid fours at like an average 3% interest rate, right? Your interest deduction is going to be less than, $20,000 a year. It's maybe like 15. Then that's the big one. You really want your home interest to carry you to above the standard deduction. And with a mixture of the new tax laws that were passed in 2016, but also very low interest rates meant that even a lot of homeowners didn't see itemized savings. And I'm shocked that this conversation isn't happening more with rates being so high. Mm-hmm. Which they, by the way, here it is, December 19th. They're way lower today than they were a month ago.
Yep.
Still in the sixes, but like we're quoting stuff in like 6.5, 6.6 right now. And so for conventional loans, 30-year loans, which is great, because we were at 8 in October. But you can't, that part of like paying around $15,000 in mortgage interest or so as an average nationally. And then the next one that usually supplies that is taxes, if you pay local taxes. So this is going to be your property tax. So with that same home purchase, property taxes, depending on where you live, range from 0.5% to 2% of your assessed value. In Washington, it's about 1%. So if you bought a house in King County with a price of, let's say, $700,000, but your rate was 3%, right? Then maybe you're barely getting itemized deductions, right? But with rates in the 6s and 7s and 8s, you're flying way over the standard deduction. So the standard deduction, I think it's about $26,000. We can look up exactly what it is, but I think it's around $26,000 for a married couple. And then it's cheaper. It's around, I think it's right around 2021 for head of household. And then it's that married couple number, it's cut exactly in half for filing single. But it's good to recognize that there's 3 different things that save you money.
Real quick.
Okay.
This is 2024, but it's 14.6 for single filers.
Yep.
And those married filing separately. 29.2 for joint filers.
Right.
And 21.9 for heads of household.
Yeah. So 14. So we're rounding it. It's 14. It's 15,000, 29,000, and 22,000.
Yeah.
So your itemized deductions have to, depending on how you file, you're going to fit in one of those 3 categories. You're going to be in the 14.6, the 29.2, or the 21.9. And you're either going to take that number that they give you, or you're going to add up all these other things that you spent money on, and they have to exceed that number, and you're only saving what's above that number in terms of how much lowers your taxable income. So, I won't get into the nitty-gritty math, but the most important thing is if you have a mortgage now of, a 5% interest rate or higher, and a loan balance of around $500,000, then you're in probably, right? Because if you have a $500,000 loan and a 5% interest rate, that's about $25,000 in interest for that year. Every year, of course, it declines if your loan's going down, but you take the property tax that go on top of it. And the key to this idea is that you really, the house does the heavy lifting of getting you over that number. And for some people, maybe the house alone isn't saving them that much money. Maybe if you're married, filed jointly, and you have $32,000 of interest and property taxes, it didn't save you a ton. But if there was maybe $3,000 to $6,000 of other deductions that you didn't claim before, it took you over the hump of being over the standard deduction. And now you need to make sure you pile on all the other deductions that you're eligible for.
Yep.
And so this is first for the general taxpayer, like people who pay itemized tax deductions. Let's just face it, they have more and they're worth more and they make more. So even if you're not a business owner, but you do make more money and you do own a home and you do have more assets, right, and buy more expensive stuff, this is very relevant. And so so let the house do the heavy lifting, and then when you can strategize things you can do around it to make it higher. Like, okay, my car tabs counts as a tax, right? I have to pay for someone to prepare my tax return. That's deductible if I remember right.
Maybe.
I've been writing it off.
But you're writing it off. If you're writing it off as an expense of your business, like preparing K1s, things like that, then
unless they changed it,
I don't think you can write off your CPA fees as an individual.
My enrolled agent who used to do my returns, who unfortunately passed away just recently, when I didn't own businesses, used to put it on my itemized deductions, but that was before the 2016 changes. So
I am not a CPA, so I don't know for sure.
Yeah.
But I'm not sure.
Yeah. The one thing for sure, though, I know that I have been doing, again, this isn't advice, guys. Go talk to your people.
Yeah.
Mortgage interest for a loan balance up to $750,000. Taxes, local taxes, which include property taxes, car tabs, sales tax, right? So you keep
sales tax. Okay, so there are caveats to all of these. They all have qualifiers that you may or may not meet.
Right.
And for some of these, you have to have a lot of documentation. Like you have to keep track of how much sales tax you're actually paying, and it has to cross the threshold for you to be able to deduct it.
Right.
Often, also, in Washington State specifically, because we don't have an income tax, you often can't itemize that sales tax federally because it's not a federal tax.
Right.
Like in Kansas, there are some things that you could do to reduce or deduct your sales tax because it affects your Kansas income tax, not your federal income tax.
Got it.
So the key, and we'll talk about more things here though, but the key is really, I think, to be kind of just curious about these things, learn about them a little bit. You know, if you think something applies, go read. There's a ton of information out there. The key is just to know that when you reach that threshold, which is what you're trying to say,
keep all of your receipts.
Well, when you reach that threshold, then you want to know there's more opportunities out there that you just haven't been using because prior to this you didn't meet the sort of the going over that standard deduction.
That's right.
Because like there are things you can do for like childcare that you can write off.
Mm-hmm.
I have a list here that I just Googled. And again, these may or may not apply to you, but this is just an example of the other things that you can add in.
What I would say is this: before Chris goes off this list, write them all down, keep every receipt that sounds like it's even associated with them, and then let your tax advisor tell you if you can or can't write it off. But start with trying to be proactive, and then when you find out what can be done, then you might actually proactively act on it. Like a good example would be if your tax preparer says, yes, you're definitely going to be paying itemized taxes versus standard deduction now that you're a homeowner, then it's the end of the year, right? If you have a bunch of junk that you've been thinking about giving away to Goodwill, now's a good time to bag that shit up and go drop it off, because this is your last few days to be able to slip it in and include it, because charitable donations count.
Yep.
Right.
Definitely. Yeah. So here's a quick list. Unreimbursed medical and dental expenses. Again, this one has have to exceed a certain amount of your income
threshold
to qualify. Long-term care premiums, which
daycare.
If you don't have long-term care insurance, you should really consider it. If you don't want to pay for it necessarily, you can get riders on life insurance that will supply long-term care for you and sort of reduce your life insurance payout. That's a topic for another time that Andrew probably should come and talk about. But long-term care insurance premiums, home mortgage, and home equity loan interest.
In equity loans, I know there's more provisions to equity loans. You can't just like take out an equity loan and go use it to cash out a bunch of money and go gambling with it and then pay and then write off the interest.
Home equity loan or line of credit interest is deductible provided that the borrowed funds are used to buy, build, or substantially improve the home that secures the loan.
Right.
So if you use it for home improvement, then do it. But that, if you're going to upgrade your kitchen or whatever, I mean, you might as well take the whole thing out now. Then you can start writing off the interest, whatever. All right. Let's see. Personal property taxes, state and local taxes. So maybe the sales taxes do apply. Okay, so it does say.
I know there's a max, like with the new tax rule changes, the local taxes you pay, which include your property taxes, cap at $10,000. So for me, sales tax and car tabs don't matter because my property tax is already over 10.
Yeah.
But when I was talking to my other client, she bought this house for like low 400s, property tax around $4,000 or $5,000, and that's for sure less than 10. So it was I definitely said you need to talk to your tax person and see whether or not you can add sales tax or whatever on top of it because you're not at that 10,000 threshold.
Yeah, totally. Charitable donations, casualty and theft losses, unreimbursed job-related expenses, and certain miscellaneous deductions. I don't know, all kinds of stuff. All I did was I'm glad
you went over that list because
student loan interest, investment interest expenses, gambling losses. Yeah, you're right. There's a $10,000 threshold for the state and local income, sales, and personal property taxes. But personal property taxes are not related to real estate, so you may still be able to do it because you have, there's real property. Personal property would be like car tabs, probably stuff like that.
Yep.
But all I did was.
I'm glad you went through that list because you know why it was not on my radar? Theft casualty losses. The fuckers broke in my office and stole my watch collection.
Yep,
It wasn't
100%.
insured.
Yep. This is alimony payments, because alimony payments are now considered to be income by the person that receives them.
Yes.
So moving expenses, tax prep expenses. So here you go. All I did, by the way, everybody.
Just Google it.
I just Googled Great W-2 itemized deductions. And there's an article from Investopedia that lists all these things out and gives you plenty of information with links to other sources. So again, how long? We've only been talking for 17 minutes, and we basically found the list of things that can save you a lot of money for not having to do a lot of work.
And look, it was my idea to have it, and one of the things on the list wasn't on my radar.
Yeah.
Then I'm like, okay, well, sucker stole that watch collection of mine. I'm gonna.
Yep. For sure.
So. Wrote down my notes. Okay, now let's go a little higher level. For business people, there's a couple of strategies I see that can really work to people's benefit. So, same disclaimer that Chris gave earlier. This is the same disclaimer. Go talk to your professional before making final decisions. But this is some high level stuff that will save you a ton of money. Okay, so. If you own your own business and you buy a property that, let me see if I can rephrase this so I don't go too far too fast. Obviously, rent expenses, if you rent a space for your business, is considered a deduction. There's a lot of potential benefits to buying and owning the property that you would run your business out of. And I see people do this, and it's a very clever way of doing it. They will typically buy, let's say, for instance, like I'm about to sign up a new lease. Let's say I decide to buy an office building. I'm not going to, but let's say I decide to buy an office building. Instead of trying to give myself like a great deal on the rent, I can charge myself the maximum but reasonable market value of what rent I could get for that space. And then that creates an income deduction on my business tax returns. And I make the building I buy its own business, its own entity.
Correct.
So if I do a market analysis and it says, hey, a Class B building in this location can rent for whatever, $35 square foot a year, right? Let's say it's 35 to 40. And I charge myself the 40. From my understanding, you can't go over what the considered marketable rate is, but I can charge myself the high side, but what would almost anyone would still appraise and say that's a typical marketable rent cost. Mm-hmm. So you don't give yourself a discount, you charge yourself max rent, but you're charging it to yourself. And so that creates a business expense, a rent expense on your business tax returns, which lowers your taxable income on the business, which for the most part is usually your highest tax rate, is income tax, typically, right?
Well, it depends. when you think about from business, to sort of take a step back, when you think about from your business what you pay taxes on, it's going to essentially be the profit from the business. The profit is sort of loosely going to be defined as what people paid you minus what you had to pay other people.
Mm-hmm.
So rent, copier, payroll, all of these things get knocked off the top, and then whatever is left is what you're going to pay tax on.
Yeah, but you're typically, if you take income tax on like a passive rental property, you pay it can become income tax, right?
It does, but what you pay depends on what tax bracket you are in.
Correct.
So you're not necessarily going to pay the highest amount. It just depends on whatever bracket you fall in.
That's correct.
Often that will push you into another bracket, so
Right.
you are paying more. You're right, but it's just taxed just the same way as the W-2 income. It just depends on where you fall in the tax bracket.
And there's different kind of entities that you'll be filing your business returns under. It could be a sole proprietorship. It could be a 1065 partnership. It could be a corporation. It can be both, right? Or it could be a C corp. But for sure, if you're a business owner, a portion of your income tax, and there's different strategies to how you do it. If it's an S corp and you pay yourself a salary, but there's always a percentage of it that is also going to be self-employment tax in addition to your income tax. So if you're
Correct.
pulling money out of that category and putting it into income tax only as a passive rental on this other entity, that's pulling down the business income and putting it into, it's still income on the other side, but there's no self-employment tax on rental income.
Yes, there could be.
There could be.
Yes, it depends on how the business is set up.
If the business is only a rental property
If
with
it's a
passive income.
pass-through LLC, you're paying everything on it.
Right. Right.
So if it's just an LLC, you have your building in and income comes in, that income is going to flow through to you personally.
Unless
and
it's,
be treated as income.
it'll be treated as income, but you don't pay self-employment tax
Yes.
on it.
Yes, you do.
I don't see it.
It's the same. What do you mean?
The K1s have income sections for regular business income and then passive income.
It passes through to you though.
Right. You still pay the income tax, but the self-employment portion, the 15.3%
Rental?
on rentals, they don't.
Okay, you could be right.
But just
I'm not
just
a
a rental.
CPA.
Yeah. Just the income tax is
You're
still
probably
there.
right. Actually, you are right. I don't think I do that on my rental. It may just be business. I mean, I guess
They
it would
consider
have
it
to be
they
business
consider it
that you
passive
are
income.
working in.
It's still
Yeah,
income tax.
You're right.
And then the other,
You're
so let's suppose that you have this, high rent income coming into this entity. It's a passive income, but it's a high rent income.
Mm-hmm.
Then there's all these other deductions that can exist, right? The interest on the loan, the property taxes. It's typical what people have on rental properties. And because you're a landlord to yourself, you get to use all those to deduct. So you take in this income, you're taking the income out of the business and moving it to the rental property, right? And then the rental property has its own deductions that can wipe those out before you pay tax on it. And the big one that typically happens in real estate that is a kick it down the road thing is depreciation,
100%.
right? And there's a new section of the tax code that was put in 7 years ago that allows you to change the rate of your depreciation. It's called a cost segregation study. And so if you combine, a lot of investors like to use this tactic, but it works great for business owners who are buying their own building. And if there is, you want to make sure there's enough profit there that the cost seg will actually be needed to offset that income. But it's a way to push down and kick down the road the chance of you paying that income tax now. And if you ultimately end up selling the property and doing a 1031 into some other asset and then not selling that one, then you end up never paying it, right?
Right. I think that what you sort of just mentioned in passing is really important to remember as a business owner when you're thinking about taxes, because you can kind of like miss the forest for the trees.
Mm-hmm.
If you are going to go buy something that you don't need or that you don't want just to save money on taxes, don't do it.
Don't do that. What this
It's
is
like because like there's like 179 the car depreciation.
yeah,
thing.
section 179 depreciation.
So some people were like, hey, I should go buy a car because I can depreciate this whole thing. The problem is you still have to pay for the car.
Yeah.
You don't actually, it's not 100% return
No.
on what you're spending. So make
If
sure
you need a car, consider
that's
doing
right.
a section 179. This is more likely the versions of the conversations I have with business owners is this. they're thinking about buying a house. They're not even thinking about buying a business building yet. But I see they're paying on their tax return an exorbitant amount of commercial rent. And the reason why they haven't thought about buying a commercial property yet is because they're already deathly afraid I'm going to turn them down for buying a house because they've been trying to write off stuff, right? So what I do is I try to coach them on like, hey, there's ways to shelter your income where we're not going to knock you on what you qualify for. Like we're still going to qualify for a loan, but it still lowers your taxes, like depreciation, right? And if your tax preparer is doing their job properly, not just lying about crap that doesn't exist as a deduction, hoping that no one catches it, and your business really is profitable, I'm probably going to approve you for what you should get. Like, I don't care how much tax you pay. The cash flow analysis as a banker is not exactly the same as the net income that you're considered taxable income, because some things really aren't true expenses like depreciation, right? So usually what happens is I say, I know you're deathly afraid and you're planning on putting 30 to 50% down because you didn't think you paid enough taxes, right? But let's assume I do get you qualified, and very often I do. I say, then maybe you should be considering not putting 30, 40% down because you thought it was going to be necessary to qualify for a house. Keep some of it, and then go buy, like, oh yeah, that was like a 5-10 year plan, because you're right, I hate paying 10, 15, 20 grand a month in rent for my commercial space. It'd be great to own it. I just thought that was going to have to be a 5-year goal. I'm like, no. If you have this $500,000 and you're planning on using all as a down payment, maybe we only use half of it. And loans like SBA loans allow you to do 10% down on a commercial building acquisition. And if that 10% down and that payment is going to be a payment that's equivalent to what you're paying in rent, maybe you consider buying. And if you do buy and then charge yourself market rent, what happens is it lowers your taxable income and it pushes the income into the building rent income. And then you can do things like cost segs to lower that income. And at the end of the day, you now have just put another asset in your name, right? You're not paying someone else's rent. It has the same kind of benefit that regular homeownership could versus like paying someone else's rent as a house to live in. And you can't do things like cost segregation, depreciation write-offs for personal income on your own house, but you can do that in the world of being a business owner.
Yeah.
I apologize. This is some pretty layered stuff. But the short answer is this. Think about what Chris said earlier. And if you do pay a lot in rent, and the idea of owning a building and paying yourself the same rent could yield you a lower more of your income for the same cost you're paying and own the building. You get to build the appreciation, you get to keep the cash flow difference, and potentially lower your taxable income while improving your cash flow. Like there's a chance that the rent you're paying yourself could be the same as what you were paying before, but after your loan payments on the other entity that owns that rental property, the office building or whatever it is, means that when you took in the rent and then covered all the expenses associated with it, that business made a profit, which net means that you ultimately paid less to live, or to not live, but operate your business in that building versus when you're renting before.
Yeah, particularly if you front load that depreciation at the beginning.
Yes.
You could definitely see some tax savings for maybe the first couple years, maybe 2-3 years or so.
Mm-hmm. And then the cost segs now, what it used to be that
front load them. I've never done one. Don't you front load it? You front load it pretty heavily when you do the cost.
What it does is it changes the scale. So there's a phase out period, and for a long time people were talking about the phase out, and it confused me because I'm like, when people say it's phasing out, I didn't know what it meant. So what happened was when they first brought out the cost segs, you could cost segregate the entire building and then write the whole thing off on the cost segregation schedule. A cost segregation is where you segregate the building and depreciate parts of it.
Like the fixtures and everything.
Yeah.
The schedule changes because the building itself might be on like a 25-year depreciation schedule.
Yep. It's like 20. I want to say it's like
fixtures might be on a 10-year schedule.
I want to say that residential properties are on a 27-year depreciation schedule, and commercial is a 39, I think. Yeah. And so it just takes the whole value of the building and depreciates it at that rate. And then
what that means is you tell me if I'm wrong. When we're talking about depreciation in like a 27-year schedule, that means you take like the value of the house and you
not the whole property, just the buildings.
You just take this whatever that number is though. In every year, you get to sort of knock 1/27th off. You get to recognize that loss because the value has depreciated on your taxes, which reduces your income basically by that.
Yes, amount. And commercial buildings are done on a 39-year schedule, I want to say.
So this is how people like Donald Trump, for example, can pay no income tax, is because they are constantly buying new real estate and they can depreciate essentially their entire stream of income in a given year.
Yep. And then
There's other things that they do, but that's kind of how real estate people really it's not take advantage of, utilize what I think would, I guess, be the right way to describe it, those rules.
Yes, and obviously if you do a cost segregation study, what's happening is they're taking that 39 or 27 year schedule. You may want to Google the schedule, by the way, just so we can get the number right, because I feel like 39 might be
You
off.
guys Google it if you care.
Yeah.
It's long.
It's long.
For the building itself, it's much longer than if you're doing the fixtures, if you're pulling things out individually inside of a building.
Yeah, and cost segregations have only existed since 2016. So the phase out period is now in a period where if they say they're phasing it out and it goes down to percentages, I finally got the word on what that means. If you do a cost segregation study and they're phasing it down, and now they're like, let's say 60% is I think what they're at now, that means they're going to make you operate 40% on the original 39-year schedule, commercial, 27 residential, and that 60%, when you could take 60% of the value and let that be depreciated on that sped up rate. So you're still getting an accelerated rate.
Yeah. It's
right?
still significant though, because you could take it from, let's say it's a commercial building, from like 39 years down to 20.
Mm-hmm.
That's a big difference.
Yeah.
You're sort of doubling your depreciation
per year.
That percentage. It could be a lot depending on how what you pay for the building or what the value of the building is.
If you can't capture what might be the net result, you might buy a building for a good deal, get decent financing terms, maybe owner financing, charge yourself market rate, and then clearly be cash flowing more. That the mortgage payment you're paying could be substantially less than what you used to be paying in rent, right? So, but what you do is you charge yourself the same rent you were charged before, which means your business is still that lower taxable income, or if you could argue why the rent could be higher, even more possibly, but then there's cash flow coming into the other business, and you say, well, that business has to pay income tax, but then the depreciation inside that entity being used to own that building is offsetting that part of the cash flow.
Yep.
So if it makes sense for you to own a building and you buy the right property and you use the right tax rules, there's a chance that you not only are taking home more money every single month, but that your tax liability has actually gone down because of the cost seg study. I haven't seen people be able to get a huge benefit on both until cost segregations came out. But a lot of people are using cost segs for just investment properties, and it's great. Mm-hmm. It's similar like qualified opportunity funds. Qualified opportunity funds, all the investors are interested in it first, but if you really look closely at it, it saves you the most money if you use it in the form of a business, because now you're offsetting business income. Like you're really using deferred capital gains to reduce your business income, and then that deferred gains gets exempted, which we won't even get into. Qualified opportunity funds are basically just taking the whole strategy we talked about earlier with cost segs and so forth and putting steroids on it. If you buy certain properties in certain locations and do a certain amount of work on them in a certain amount of time, and also defer capital gains from another investment, then that building you bought, you might not have to pay any capital gains on it.
Right.
Which I do have one of those.
Yeah. And this to sort of take a little bit of a segue, might be a good time to explain why the tax code even exists. These exemptions for business expenses, qualified opportunity funds, cost segregation, the reason that all of these different things exist is because the government is trying to entice you to take action. They want you to buy these properties, so they're giving you a little bit of a discount in the way of tax so that people move things in the economy.
Yeah.
That is the reason that these things exist. So if it seems like it's a good deal, that is the point.
Yes.
The tax code
really
is complex because they want people to take action and do these things. So when you think about taking advantage of the tax rules, you are really just doing what they want you to do, because you are much more likely to, for example, buy a commercial building when you know you can depreciate some of the cost up front and save some money in these other places. But what the government gets is the exchange of money in the economy. They get growth. They get same way you can write off your expenses as a business. If they didn't,
they're not happy if your money's just sitting in.
Correct. They want the money to move.
Yes.
They want movement of money.
With movement comes other taxes.
That's right.
Sales tax.
That's right.
Excise tax.
Yes.
Right.
So when you think about these things, if they seem complex, or if it seems like there's a bunch of different rules, they have just tried to come up with really as many different ways that they can to encourage you to take some kind of action, essentially. So that's the reason they exist for residential homes as well.
Yep.
Believe it or not, because
You own a home, you buy appliances, you buy furniture,
Yeah.
you buy blinds,
it's
you buy
just one
whatever.
more reason to get you to do stuff.
You get equity loans that'll help you buy other shit.
100%.
So
Yes.
one thing I thought was worth bringing up in this discussion also is that, that was a really good point, right? People sometimes think that business owners are like working the tax system, but it does benefit the government for doing these things. But the other thing I wanted to point out was this. A lot of people will take the approach of like, well, I don't want to have to think about this stuff. So why don't I just hire a good tax person and let them come up with this stuff for me? That actually is the attitude of almost every business owner I know. They don't want to think about it. They gather the docs. They let their tax person do their taxes. I know I'm on an island with this thought process, but I can watch myself making way more money doing it. This is what I have these different moments where I put something in play and I'm doing something that's like a delayed benefit. And what I feel like is happening internally is like, you ever seen those scenes like in like Star Wars where they go to light speed and like you see the stars and all these white lines? I feel myself flying past other people financially when I do these things, like that same way that you're going to light speed, because I can see that they're just overlooking this thing. And one of those things is when I business plan with taxes in mind, that it's like the entire business plan had taxes in it. Like I was planning, I'm doing this investment, and I'm not just doing it for the tax benefit, that I took the time to come up with a business plan that not only will make me a lot of money, but have huge amounts of tax shelters. And I see what it's going to turn into 5-10 years down the road, like my Qualified Opportunity Fund, right? With the first year and a half, 2 years, I tried to design a business plan that on all accounts made sense. And for the first 18 months, I kept on falling back in the same. I actually found business plans that make money. Now, I'm not just doing it for tax savings, and there's a tax shelter. But I might make more money just doing a different investment in a different spot that makes me more money and just pay the tax, right? It took me some time to figure out a few properties and a few business plans that like I would want to do this regardless. But I see that I can do this in a qualified opportunity zone, and I'm going to make a huge return, and it's going to be tax free. And once I realized that, and once I realized what those business plans look like, I basically bought one property for $1 million that I project I'll probably make somewhere between $7 to $10 million in gain on in the next 10 years. 7 to 10 million in gain.
Yeah.
And it will all be exempt. It will all be exempt. And once you see that business plan, you start to see other ones like it. In a very sad way, because I forced myself to see that point of view. I've had colleagues, clients who I will look at their real estate and then I go, hey, I know that area. You might be in a qualified opportunity zone. When did you buy it? And then I don't mean to rub it in their face. It's kind of just like, oh man, I wish that we talked earlier kind of a thing. But on multiple occasions, it's really hard to operate a qualified opportunity fund. There's a lot of rules of what you need to do. But there was at least 4 different times where the person I'm talking to literally did 90% of everything you're supposed to do to make it a qualified opportunity fund, including buy a property in the zone.
Right.
And all they forgot to do was like flip this switch, flip that switch. And those switches were very small.
Right.
Some of them were like, oh, I could have sold this asset and used this gain to fund it versus this cash I had already saved. And I could have just swapped where the cash was. And I had to designate it within a fund within the first 6 months of acquiring the property.
Right.
Like the easy parts. Finding something you actually want to buy in that location and doing all the work that's necessary to in a certain window of time is the hardest part. And all of them did that.
Yep.
One was I won't use names. One is a client of mine that has a pretty large retail business in multiple locations in the state. Started in Bellevue and realized that his best businesses were actually coming out of places like Everett, Tacoma, which they both have qualified opportunity zones. Bought a dilapidated building on Pacific Avenue and did the full rehab the way you're supposed to. And he for sure could have sold assets for a gain and done that. He did everything you're supposed to do, except for flip a switch, call it a fund, and use the money from gain versus just saved money. And he for sure had assets he could sell as a gain to do it. And he did all the hard work. And he did all the other strategies we talked about. A different entity owns the building. It rents back to his business to lower his taxable income. He did all that part. But when he one day sells that building, he now has to pay capital gains tax on it and the depreciation recapture on the depreciation. And if he just did those two small things, he would never had to pay either one of those back. Millions and millions of dollars.
Right.
The second person did it with an apartment building in Everett. And the third one, this was really sad. Third one, because his buildup was really expensive, was building server farms in Eastern Washington. These are multi-million-dollar improvements that he's putting on these properties, right? And they were all in qualified opportunity zones. And same thing, all the right tax strategies if you're having the entities in place, except for designate as a fund and make sure you use gains to invest in it, and just miss that chance.
Yeah.
And you know, his depreciation on those buildings, on each building, was hundreds of thousands a year. Hundreds of thousands a year. Millions. The building improvement costs, he basically established close to $5 million worth of depreciation that he was going to take over the next couple of years. And all he had to do was flip a switch, and he would never have to pay any of it back.
Yeah.
And it's sad. So that's why I felt it was important
to close the loop on what you were saying, I think too, when you started, is, you know, everybody wants to try to rely on their CPA to give them this advice. What I think it's really important to know is that CPAs have one job: prepare your taxes.
Yes.
That's their job. You give them what you have, they make sure it goes in the right slots to save you as much money as possible.
Right.
That's what a CPA does. If you want a tax advisor, you are going to need to seek those people out in real time, and you are going to have to pay them extra money.
Yes.
This is what people don't often realize. What you are getting with a CPA is tax prep.
It's basically a higher level version of the exact same thing we said earlier in the show, which was Google the list.
Yes.
And then go there and plan. So I had to learn what qualified opportunity funds were, cost segs were, and then bring those conversations make sure first I have the right person.
Yeah.
After I have the right person, then I'm pushing it on them. I want to do this. How can I do it?
Right. What are all these check boxes that I need to hit? And then you make them up, and you make sure that you're doing it as you're going through the process. I think that. Oh, I'm curious. Did you learn about qualified opportunity funds just through the course of your career? Like, how did you even?
It was when the tax code first passed in 2016. I had a client try to buy a rental property to qualified opportunity zone. I don't think they were paying attention to all the factors and ended up backing out of it. Mm-hmm. But once I realized what they were trying to do, and I learned what the tax benefit was, I was like, there's no freaking way. Like this thing, so basically a qualified opportunity fund, it could be a business or property, but it has to be in a certain location. But let's just talk about it in the real estate sense. In the real estate sense, you're buying property in these specific areas. You're supposed to defer gains into it. And you're literally creating its own entity. It could be an S corp, C corp, or partnerships. Typically, you do them in partnerships. And once you create the entity and acquires real estate in the area, the money you're using should be deferred gains, because the portion of it that's going tax free is based off the percentage of money that's deferred gains. So you can defer gains of any investment into it. It doesn't have to be real estate. It could be like, I sold a baseball card collection for a profit. I sold classic car for a profit. It could be real estate, but it also could be stock. So it could be any kind of investment. And there's a window of about 6 months that you can move those gains into that entity you created, and then it has to go acquire real estate.
Right. So deferred gain is basically, I stole my Apple stock. I bought it for $10. Now it's worth $1 million. So
the 990,000 is of gain.
That's right. I'm out to pay tax on this if I don't find some place to put it
in the deferral
that qualifies for it to not be counted as taxable income in this year. Which is a qualified opportunity fund.
Yes.
So you can take that 990,000, you can put it into this new entity, you can buy real estate in a qualified opportunity fund, and while it's there, it does not have to pay. You don't have to pay tax on that gain. And
until you sell that.
As long as you follow the rules, there are some other things that will happen.
Yes. The rest of the rules are it has to be deferred gains. You have to do a substantial improvement to the property. There's 3 different versions of it. It's either occupied, dilapidated, vacant building that's been vacant for years. That's probably the hardest one. Mm-hmm. The second one, which is still pretty hard, is build raw land. Or the third one is, which I think is the easiest one, is but again, it depends on the property.
Yeah.
Invest equal amounts of the improvement value back into it. And the IRS will allow you to use the tax assessed value as the basis of the improvement. So what I was doing was I was looking for properties that were naturally good value adds that I knew I could make worth a lot more money in opportunity zones, that also the assessors probably didn't do the best job of assessing the improvement value. So the one I bought was a waterfront property in Angle Lake, had 4 houses on it, and I came up with this idea of like, okay, well, do I have to invest 100% of the improvement value if the fund doesn't keep all of them? If I condo them, which is what I do, and sell off one, then could I just do the portions that was retained? And the answer was yes. So what's funny was the biggest house was the one that I won't say had the lowest value, but it had the least upside because the property was basically a waterfront lot where there was a house at the street and then a bunch of houses over by the water. So there's 2 little houses and then a normal house by the water, and then there was a bigger house over on the street entrance, far from the water. So obviously waterfront properties appreciate better.
Yep.
So when I broke it up into 4 condos, I sold the big one on the front. The whole property was only tax assessed for like $390,000, and like 40% of the square footage was in the front house. So I was able to take 40% off of $390,000, and the remaining 60%, which is a couple $100,000, is how much I had to put into the front 3 houses. Well, they were all outdated. So now it was
did
hard.
Did that still count though, because what you put in as deferred gains was still below?
Yeah, as long as
counted like
yeah,
because
I financed it,
loan or whatever.
Yeah, I financed it. I still could prove the dollar amount that went into it.
Right.
And so then I improved all those 3 front buildings that met that 100% of that low tax assessed value, turned to condos, and I paid 1.3 for the whole property, sold the front house for like $400,000, so basically got 3 waterfront houses for $900,000, and only had to put $200 into them, which was an easy thing to do. Yeah. And when I was all said and done, the value of those front 3 were about 1.7. Right? So basically, I'm into it for like 1.1. It's worth 1.7. Locked them in at low interest rates, and then started renting them out. Right? Mm-hmm. And the next piece is after you've done all that, there's all these different layers to it. But the short answer is you hold it for 10 years. You don't want to do one of these unless you're holding it for 10 years. Once you've passed 10 years, then all of the capital gains that you've earned on that property, all the value that's gone up, if you sell it down the road, you don't pay any tax on it. And the depreciation that you've been using to offset your rental income, the same one that we've been talking about in the show, is also exempted because that's considered capital gains. And the tax code that had qualified opportunity funds is the same tax bill that passed that has cost seg studies. So they were designed to work together, right? You buy the building, you improve it, you hold it for 10 years, and you speed up the depreciation, and you get most of the depreciation used in that 10-year cycle. Then somewhere around 15, 20 years, you've exhausted all of your depreciation quickly. So you paid no income tax on it probably. And then you sold it, and you had to pay any of that tax back or the gains.
Yep.
I mean, it's beautiful.
Yeah. Think about why the government would want you to do that. Qualified opportunity funds are in places that
qualified opportunity zones
that they want growth.
Yes.
They put a 10-year rule on there because they want you to be invested in that property for
They want you
years.
to fix up this crappy building in this bad location and be responsible for it for a long time.
That's right.
Yeah.
This is just an example of how those things happen, but you can get significant gains if you understand the rules.
And the beauty of it really is this. Yes, they're not necessarily considered the best locations in real estate. But like think about the story I said about the friend of ours that had that building he bought in Tacoma. Mm-hmm. It wasn't as good of a location as his Bellevue one, but he makes more money in his Tacoma location he did in Bellevue. So he spent more money on the improvements there. And so maybe the true capital gain won't be as high as his Bellevue one, but the depreciation recapture to offset the income was definitely needed. Definitely needed because he was making more revenue out of that location. And to be able to set it up where he doesn't have to pay that money back, he was going to buy that building and do that anyways because of the cash flow he's going to make.
Right.
And this is where
that you get the cap gains deferral.
Right.
That you're putting into it.
Oh, that portion, when you eventually do sell it, you do have to pay it back. But if you do hold it for that whole period, it's discounted. At 5 years, they discount it by 10 basis, and then at 7 years, they discount it by 15. Oh. But since you have to get to 10 to get the cap gains, you're always going to go for the 10, which means you ultimately get the 15.
Right.
So you get 15. So if you deferred $300,000 into it, right, then $45,000 of that $300 is taken off the top.
Yeah.
And then you only pay capital gains on the 85% of what you put into it on the deferral. So you get a 15% haircut on your deferral, and then
That's still pretty good though.
No, I mean honestly, you're doing it for the cap gains.
Yeah.
They could have taken off that deferral haircut, and I'd still do it.
Yeah.
So the exciting part about it was funny because this is a tax code that everyone got super excited about. I had new people but I actually don't know that many people have actually seen it through. And I admit that I had to write lots of business plans to come up with one and find a property that checked all the boxes.
Yeah.
But hey, you can't do a 1031 exchange with international property. And I've always had this long-term goal to have other properties in other countries.
Yeah.
So that asset is going to be some cash in the bank and down payment funds for out of the country real estate, because I could just sell it.
Tax free when you sell it, basically.
Right.
Absent the
That's right.
deferred cap gains.
But my deferred cap gains in it's going to be less
tiny.
than $500,000 over a 10-year period.
Right.
So I'll pay tax on 85% of the $500,000, which is not. I mean, in relative terms, if I end up making $7 to $10 million in gain on the property and I don't pay tax on any of that, then who cares?
Yeah.
But the hack is, and this is where people think, oh, well, that's too complicated. I'll just invest in someone else's fund or whatever, because some of these exist as funds. My issue with the funds is this. There are some funds that are doing like a local deal that I think are worth doing. But the problem is that if you actually study what like our financial advisors can offer, any large fund, like if some large company, Morgan Stanley or whatever, is offering a qualified opportunity fund for you to invest in, it's going to probably be a shit investment, because brokerage houses that big will never offer an investment unless there's at least multi-$100 million, if not billion-dollar capital raise, because it's too small.
Mm-hmm.
If they put something on the books and offer it to all their planners, there needs to be enough of it to go around. Well, if you think about the definition of these investments, they're buying properties in not very good locations. Now think about what I said my investment was. I looked at all the spots that were eligible. 90% of them, like, I would never want to own anything over there.
Yeah.
But as a local real estate person, I can look around and be like, hey, look at that over there. This is waterfront real estate that has a development upside to it with very minimum cost.
Yeah.
And even though it may not be the same as Lake Washington waterfront on Angle Lake, it's still good. By the way, parts of Lake Washington are actually considered a zone, like in the Rainier Valley. So I was like, hey, this is still King County waterfront, lakefront property. Mm-hmm. It's still going to appreciate better than the average deal is going to in King County, because it's still a lakefront property. Yeah. So I find that sweetheart gem, like a sniper, and then find a business plan that works for it. Now I'm going to get great gains on the property, plus get the tax exemption. So but it took me trying to think about how to be a local investor and business owner and push the tax code onto something. And people say, well, I don't know if it's worth the effort. Yes, it took a couple of years. But what I would also say is this. I didn't have anyone coaching me on it. I just kept on forcing it. And so if you can find someone who's done it locally, like, look, if any of the listeners are saying, like, I want to do one in Washington, I wrote like 4 business plans. I'll just freaking give them to you, right? Because the property I bought actually has a lot of land that we could develop in the middle. So I'm not looking to acquire anymore. I'm just going to focus on that one.
Right.
And that's the only one I'm going to do. So all that research, I'll just give it to you, had to do a development deal and have it grow tax-free here.
I think the key, though, even if you are like, look, that's too much work, I'm going to just go invest in some kind of other, partnership or, investment fund, you still want to understand how the rules work. And you still, if you're going to do that, want to make sure that you read how the fees are paid out, who gets paid first, all of these other different things, because those exist and some of them are great. But the people that put those together, put them together because they make a little bit of scratch off of them.
There's a
lot of scratch.
Not only that, but it exists. And by the definition, if they're going to do a $500 million capital raise for a qualified opportunity fund to be sold at Morgan Stanley, JP Morgan, whatever, right? They have to buy dogs. Yeah. You can't be we could literally get all the local real estate experts, commercial and residential, and find every sweetheart sniper property that would have amazing upside to it. And to get all those owners to sell in a time frame that $500,000 capital raise could actually be used is almost impossible.
Yeah.
So to actually have great returns and get the tax-free exemption is nearly impossible unless you are doing a private one-off deal that works great because you know the area, right? Like those examples I gave of those other business owners. They never even thought about getting a qualified opportunity, making a qualified opportunity fund. They essentially did everything they're supposed to do except for have it, forthcoming in their mind, and they just missed that chance.
Yeah, you would want to have you would want to be doing some. Here's the thing: what you really want to do, if you're interested in real estate or if you're interested in business taxes, there are podcasts out there, and there are YouTube channels. There are even TikTok channels.
And I would push you
Where-
to get into some kind of local mastermind group, because the best business plans will work for your local market
Yeah,
too.
they will, but they will. Mastermind groups are tricky though, because there are a lot of snakes in mastermind groups
Yeah.
that are good at showing you the upside of something, and not telling you as much about the down. It's just like investing in one of those big funds, essentially. You know, I think what one needs to do is take responsibility for their own education. With the information that's out there, even like Bigger Pockets podcast, there's tax podcasts out there that are relatively interesting. All you need to know, you don't actually have to know how a qualified opportunity fund works. What you need to know is, I'm about to buy something. Does this work as a qualified opportunity fund? You just need to know to start there, because then you can ask other people that can tell you and look at the situation and say, these are the things that you need to know about.
Yeah.
You need to know because I think the downside, even to the examples that you were talking about, is they didn't even know that these things existed.
The real, I guess if I were to summarize what I was trying to say, it's this. You already have a real estate business plan in mind. Force the conversation of whether or not these shelters could be used on what you were going to do anyways.
Yeah.
Is there a way that you could save more money on your flips, on your rentals, on buying your commercial building? Like, don't skip over.
But you got to be curious about it.
Yes.
Even if you're doing a flip and you just do like income tax hacks for flips, just Google some stuff and see what comes up and be curious. If
you
don't
hear
have
there's
to
a good
become
tax shelter.
Yeah, you don't have to become a tax expert, but you need to find out what exists out there. And that information is widely available.
Here's the way to pose your question too. Because what will happen is you'll share your business plan with a tax person. They'll tell you why it doesn't work, and then you'll give up.
Correct.
The right way to pose a question is this. Here's what my business looks like. What version could I be doing this where this tax code would apply? I know that maybe what I'm doing on the surface won't work. But what version of what I'm doing, if twisted just a little bit, would fit that tax code?
Yeah.
And then you can decide if it's worth it. Because what I see people say is like, oh, I thought about I was going to flip a property, a qualified opportunity fund. Oh, but you got to hold for 10 years, so it doesn't work. Okay. Well, did you ever plan on holding long-term rentals? Okay. Well, maybe you should do flips in other areas, long-term flips that you maybe rented for a little while, could be long-term gains. You could use that to buy one in this other area and make your long-term rentals a qualified opportunity fund in this area.
Yeah.
Right? Like it could. Surface question may not be a yes.
Or on the flip side too, you could go to your tax person and say, I'm doing flips. What are some tax things that I could do that will utilize this type of scenario? Right?
Yeah.
I'm having a lot of income that's coming in. It's going to get taxed. Where can I put it? What can I do with it? Like, are there other things that can happen? Right? So like,
yes,
that's another way that you can go. So if you have a strategy that works, you can find. It's just like when you get over the standard deduction and you start looking at all the other things, it's the same thing. You're just like, I'm doing this. Now, where does all this stuff fit in? Right?
Yep.
I bought a car for my business because I needed a car. And I said, I need a car.
I know it sounds like a pain in the ass, but here's the thing about taxes that's also true. If you don't take the time to do it, it doesn't matter if you don't make that much money. Your whole reason why you're trying to not do it is because you want to spend more time making money. But the more money you make and the more time you don't spend doing it, the more they take, right?
That's right. This is a knowledge is power type of a situation, in addition to just like saving you money.
Yes.
Like, it's just good stuff to know. And you don't have to be a professional.
No.
Like, you've seen me mess up in this podcast 10 times.
But listen to other experts, write down the bullet points, and then push the conversation.
That's right.
And if your tax preparer isn't qualified to handle the conversation, or they keep trying to get away from it because they're uncomfortable with it, then explore getting someone different.
Yes.
Your team needs to be top notch. You need to be curious. Because because here's the thing, the people who don't spend time thinking about the taxes are focused on making money. If your dream comes true and you start making shit tons of money and you keep ignoring the taxes, that's like saying, I want to figure out how I can get from where I'm at to, let's say, like India. And I'm going to do it by only running and swimming. And if you just took some time and said, I'm going to build a jet, it will take some time to build the jet, but once it's done, I can get to where I'm going to get to, versus the other way, I may never get there, right? the friction of the tax liability will bury you, because it just makes so much of what you're doing in terms of work give you so much less of what your return is, because they keep taking more of it.
Yeah.
I've been that person. I've been in that highest tax bracket. I mean, there's taxes I paid that I didn't even know existed.
Right.
Right. Like I remember when I first started making money, there's a moment where you get past this, like a lower, moderate 6-figure income, and you stop paying Social Security and Medicare because there's a cap. And then there's a gap where you don't make any money. You don't have to pay that tax.
Uh-huh.
And then you break a barrier, and then it comes back.
Right.
It comes back. I'm like, I didn't know that existed. Oh yeah, that's the we're gonna tax the really rich people tax.
It's like what about like the alternative minimum tax?
Alternative minimum tax.
That comes in there too, right?
Medicare surtax.
Yeah.
Yes. And it's like, I didn't know this stuff existed.
Right. Yeah, having high income is not necessarily the goal of any business owner. Like, you want your business to generate a lot of profit, but you don't necessarily want that profit rolling down to your 1040 or whatever.
No.
You want to try to use it. You want to try to find places to use it that are fun or interesting, or
there's all these different kind of exemptions in the tax code that when you see them, just don't miss the chance to use them.
Yeah.
Right. So, yeah, it's exciting.
Yep. Cool. All right. I don't know. We're good?
Yeah, I think we're good.
That's a good place to wrap up, I think.
I think so.
Okay. Awesome. So, if you like this, share it with somebody. Again, we talked about a lot of stuff. Go talk to your professional before you start running around doing stuff. Thankfully, I don't think we really talked about anything that you could just go off and do willy-nilly.
No.
So,
we want to give you the idea so you could take it to them.
Yeah, but the
and
concepts,
define your plan.
Yeah, the concepts are really important. So, if you hopefully you got some out of this. If you did, you want to share it with somebody, that's great. If not, that's fine too. We don't care. And that's it for today. So, as always, I am Chris.
I'm Keen.
This is the Business Barbershop Podcast. See ya.
See ya.